Hello, my name is Tom Steyer, and thank you very much for having me here today. If I don't have anything intelligent to say, please blame Drummond for going cross-country skiing with me all those years. And let me say, since Drummond seems really time-conscious, that I intend to be brief. And let me say I'm also proud to be the only person here wearing a tie. As you may know from the literature generated by this conference, I wear a number of hats in the business world, but the views I'm about to share are mine, and they really aren't those of any organization I'm involved with. In fact, I spend a lot of my time with business people who believe that government is largely unnecessary and unhelpful. And since I live in San Francisco, I spend the rest of my time with progressives who think that business people take a lot of money from society without giving any real value back. I believe both those views are wildly outdated, extremely oversimplified, and dangerous. In any case, the relationship between capitalism and government remains unresolved even after 216 years. The two sides have never fully accepted the need for the other, and the press seems sure that both are characterized by venal fools. For years before the New Deal, the surrogate for any real regulation was caveat emptor, buyer beware in Latin. Trust, as a concept in the marketplace, wasn't valued. And the most visually memorable example of that failure was the lines of people waiting to take their deposits out of failed banks and S&Ls in 1932. Does this sound familiar today? That picture didn't reoccur for 76 years because of a government innovation called deposit insurance. At the same time that the government recognized its obligation to regulate the country's capital markets in the New Deal, capitalists discovered how incredibly unfair it was for the government to regulate their unfettered freedom to do whatever they damn well pleased. My grandmother, she's going to be a recurring theme in this, I warn you, told me that in her youth, there was a very common nerve tonic called Lydia Pinkham's, which in those unregulated days was overwhelmingly comprised of alcohol. Now, I know my grandmother didn't soothe her anxiety with anything that wasn't approved by the FDA, or at least the Consumer Protection Agency. But looking at Drummond, I feel highly confident that his grandmother was a regular user of Lydia Pinkham's. On the other hand, we've seen hundreds of examples of a business-government mix where the model is that the government owns the business. My personal favorite, and in my opinion, one doomed to fail from the get-go, was watching the French government's attempt to operate a commercial bank. Although this was never proved in court, it was commonplace knowledge in the marketplace that a $100,000 payment to the loan officer led to a $10 million loan, which is a pretty good investment in bribery. Now, of course, I know not every loan officer stooped to that deal, but what I also know is that the level of corruption we've observed in countries around the world where the government controls the means of production is grim and consistent. We invest all over the world. One of our hugest worries in that is being able to carry out an honest, free trade, and we've had a chance to look at virtually every continent in most countries and certainly every major country. Ask yourself how many functioning democracies with truly independent judiciaries and the rule of law exist in major oil-producing countries. The answer is that where the government owns all the wealth in society, power is not broadly shared. All of which analysis sounds nice, because it's easy to look back and see that we agree. What's tougher, presumably, is to talk about current examples. So let's take a quick look at Freddie and Fannie, the two government-sponsored mortgage entities that are in the news today. They are New Deal, quasi-public, quasi-private creations designed to provide a bulwark for the mortgage market. A few years ago, the one thing every smart aleck commercial bank in SNL could agree on was that the so-called GSEs, which are the government-sponsored entities, had unfair advantages and were ruining the mortgage market. Now, to be fair, there was something to complain about, but it wasn't that the GSEs were an unnecessary political creation. In fact, as these very same brilliant free market banks and investment banks have blown up their credit ratings and solvency on failed mortgage investments, the only players left standing in the market have been the GSEs. I think they're currently doing about 75% of the mortgages in the United States. So they were and are necessary. The problem with the GSEs isn't that they're unnecessary and unsightly wart on a beautiful capitalist face. It's that the government has bowed too much to the capitalists recently, has been too impressed by loud suspenders and fancy degrees. Regulators relaxed credit standards so long as assets were to be immediately bundled, securitized, and sold, and in so doing produced an historically catastrophic false housing boom and the inevitable bust. That undermining of the mortgage-backed securities market threatens to take down the very banking system these GSEs were designed to protect. For months, it's been apparent that the GSEs and regulatory entities of the US government have done a very poor job of representing its and our interests. The GSEs themselves are dramatically and dangerously over-leveraged, and the interest of its owners and managers, so its stockholders and the professional managers who run them, are distinctly separate from the interests of the rest of us. They own an economic interest that ends at zero on the downside, even though the risk extends far beyond that to the bondholders who have 99% of the money up. Literally 99%. These are levered. These have 99 times the debt that they have equity in these companies. It's a classic case of heads I win, tails you lose. If the enterprise value goes up 10%, the top 1%, let's see if I can turn this page, gets it all, 10 times their money. If the enterprise value drops 10%, they lose all their money, but no more than that. The other 9 times their money is owed by bondholders, or in this case, it actually will be the government, which means the taxpayers. And the mortgage system suffers as a result. An appropriate government action, given the quasi-public charge of these companies, would be to compel them to raise huge amounts of new equity, diluting the interest of the shareholders, but bolstering the position of taxpayers, mortgage seekers, and bondholders. Recognizing when the market incentives are incomplete or suboptimal is the job of the regulator. They must solve the problem and continue to vigilantly monitor the system for perverse incentives and market failures. The issues with Fannie are compounded, however, by its political nature. Its management has been dominated by people with political rather than financial backgrounds. Even if their behavior is vastly better than the aforementioned French bank, they have evidenced a deeply flawed misunderstanding of risk. Now, that's been true at almost every major bank as well, but for an institution designed to serve the public as well as its stockholders, extreme risk aversion seems pretty darn appropriate. Let me choose one more current example, which is energy. It's the perfect opportunity for government to recognize the market imperfection, that we don't charge the true cost of burning carbon in our society. And the government can make sure that's taken into account for the good of us all. And then private enterprise, parts of which will fight the carbon tax every step of the way, can figure out the new trade-offs. As Mao said, we learn to fight the war by fighting the war. So where does that leave a progressive capitalist, as opposed to the more traditional progressives or more cartoonish capitalists? Unfortunately, it leaves us sweating the details of trying to align personal and social incentives. And I believe it's our collective burden to try and move past what I've described as the parodies of government and business. We need to design the financial system to harness private energy. You okay? But we need to design the financial system to harness private energy, but achieve public purpose, just as we did after World War II with Bretton Woods. We need energy incentives that make sense for the planet, not just for whichever aspect of the industry has lobbied hardest in Washington or surfed the waves of public opinion in times of crisis. Getting these right, unfortunately, is hard and direct work, but that is our task, and I believe we absolutely have to do it together and with respect for each other. We have to grow up and get it done as citizens. And since I know I have a little time, I'd like to tell you one quick story about money, which is this. Probably 25 years ago, I went to see my grandmother, who was about 85 and living in the Midwest and had a month to live, although I didn't know it at the time. She was quite a mean lady. But I knew she was really sick, and I thought, this is going to be my one chance to ask her what she'd learned from her life with no incentive for her to tell me anything but the ugliest truth. So I said, Granny, what would you tell me, going out into the world? I've got one more year of business school. What would your advice be? And she said, you'd be surprised. Money is more important than you think it is. And I thought, wow, I was expecting love. It's all about your family. Leave the campsite better than you found it, something I could share with Drummond on a cross-country ski. No, money is more important than you think. So I said, well, what do you mean? And she said, well, there's not a lot of difference between being moderately well off and being rich. But there's a hell of a lot of difference between being poor and being moderately well off. And I've been all of those three things, and I can tell you that when you're poor, you spend your whole time trying to figure out how to get through the day. So I believe that story from my mean old granny points out the flaw in most economic models, where a certain amount of money is assumed to mean the same thing to everybody, regardless of whether it's their first dollar or their last dollar. It doesn't, and she was also an intelligent granny. Thank you very much.